This series is part of our education initiative, where we bring exceptional presenters to our audience to help teach us how to run better businesses, find more clients, be smarter about entrepreneurship, and super excited for today. Everybody loves tax time.
And it's always about taxes. It is my absolute genuine pleasure to introduce Nacondra, who is a tax expert. I won't steal your thunder and share the story that you shared with us, but I do hope you'll tell us a little about your background. And so Austin, who's not here today because he's like on a beach or something, whatever. Austin mentioned Nacondra as just someone I think that he admired your work. And so I went into this thinking that Austin knew you and it was like a connection. And it was like, oh no, I don't know who that is. But from that first conversation, you have just been so easy and fun to talk to. And honestly, it makes talking about taxes feel like maybe it isn't the worst thing in the world. So I don't think there's anyone else that I would want to hear about taxes from besides Nacondra. So as you have questions about taxes, feel free to drop them in the chat or in Q&A, and we will answer those all at the end. Without further ado, Nacondra, I'll hand it over to you.
Hi, everyone. I am so excited to be here and to share with you all, hopefully, some good financial insight that you can use to grow your business. So I have created just a short presentation of some things to think about as you are growing your business. And I look forward to any questions that you all have at the end. I'll be happy to answer them. So I'll start the slides and then I'll kind of introduce myself and also kind of share with you why this work is important. All right. All right, so hopefully everyone can see the slides. This presentation, of course, Moxie, this is a workshop series, tax tips for entrepreneurs. So I am Nacondra. I am the owner behind Exceptional Tax Services, where our primary goal is to really help bridge the wealth gap through entrepreneurship. I really kind of started my journey from being a previous IRS employee. I worked for the IRS for almost 5 years. And as I started to have a family and children, I started to yearn a freedom and flexibility that no 8-to-5 could give me. And so through that, I decided to stop working at the IRS, and I created my business, Exceptional Tax Services, really with the core key principle and goal was to really help entrepreneurs. And the reason why was really because I dealt with a lot of entrepreneurs at the IRS, and I was really able to see how much of a pain point this is and how much of the money side to your business can really make or break it. Just not knowing what you don't know, maybe feeling like because you may be a first generation business owner, it could be difficult for you as a freelancer. So, any type of kind of scenario that you could think of, I just noticed from working at the IRS how this was such a pain point. And so through our education, through our tools, through our support, we really help grow sustainable and profitable businesses. So whether you are a freelancer, small business owner, all of these tips that are included in this workshop is applicable to you. And I hope that this will help you along your journey. All right, so we are going to be talking about selling through tax season with ease, learning practical steps, to organize your finances and to save money. So what we are going to be talking about is 4 simple steps that will make tax time easy. We are going to be talking about the importance of maintaining organized finances through bookkeeping. We are going to be talking about the 50-30-20 money framework for setting aside funds for tax payments. We're going to be talking about the significance of making quarterly estimated tax payments to avoid penalties. And then lastly, the benefits of consulting with a tax professional for tax planning and for maximizing tax savings. All right, so when we first start our business or we first start, freelancing, a lot of us are running our business, quote unquote, as a side hustle. So you may be working a W-2 and you may also be freelancing on the side. And there's always what I call a mindset shift that really has to change for the finances side to your business once you become a freelancer. Because when you are working and you're receiving a W-2, they are already taking that money out of your, paycheck. They're taking out Social Security. They're taking out Medicare. They're taking out taxes. You really are not thinking about taxes in that way when you are working and receiving a W-2. You really don't enter that conversation or really start to think about all of these things until you become a freelancer, until you become self-employed. And then you realize that you really have to pay attention to being proactive with the money side to your business. And a lot of times it's not only you bringing in money, but what do you do with the money once you actually receive it, and how to be conscious of setting aside money for taxes or being better prepared for taxes. Because unfortunately, with the nature of being self-employed, we are getting all of our money in our pocket. So we're responsible for making quarterly estimates and for proactively saving for taxes. So the importance of just maintaining your organized finances, this is all going to help you for tax time, because the root of a lot of, you calculating any estimated tax payments, you being prepared for tax season, the root will always be through your bookkeeping. Bookkeeping is the foundation that is needed in order for you to have proper tax records. So, being proactively prepared by making sure that you have bookkeeping and separate accounts. So your bookkeeping is completely separate than your personal business account, than your personal accounts. These are all ways to really help maintain organization that trickles on down to tax time, because as long as you have proper setups of your bookkeeping, whether that's a spreadsheet, whether that is QuickBooks or Wave, which is a free option for you to maintain your bookkeeping. And as long as you are proactively trying to keep everything separate, meaning you set up a business account and you are not commingling funds, having your personal and your business commingle, these are all things that really set you up for success when it comes to tax time, because your bookkeeping is really the expenses that you are reporting when tax time comes. So this is a foundational level that will help you just making sure that you have your books set up. So if you have not, maybe just setting up some type of way that you're going to keep your books, whether that's a spreadsheet or using some kind of accounting software, and then just make sure that everything is separate, so that you're able to clearly see what's coming in and out of your account. That will also help you have a lot of clarity as far as if your business is running a profit, what are you spending your money on as far as any expenses. It will also give you clarity that you can use to help you make financial decisions in your business that could also help you grow if that's what your intention is, as well as a freelancer. All right, so inside of my company, Exceptional Tax Services, we teach what is called the 50-30-20 money framework for setting aside funds for tax payments. But it is not just the idea of setting aside funds for tax payments. It's also just being cognizant of what to do with the profit from your business. And it also gives you kind of like a twist on profit first. It's not exactly profit first. It doesn't require you to have multiple bank accounts or things like that, but it's an ideology that allows you to see what you should be doing with your income or your profit after you receive it. So the 50-30-20 framework is where you are going to be allocating 50% of the profits towards your owner's comp. So basically you paying yourself at 50%. 30% is what you are going to be allocating for taxes. And then 20% is what you are allocating for profit or reinvesting back into the business. So the whole idea of profit first is very similar, and these percentages can also be changed. But the idea behind it is that you want a framework for where the money in your business goes. So as a rule of thumb, owner's comp, paying yourself is at 50%. But if you're in a season where you feel like you want to reinvest into your business, you could change it. You could pay yourself 40% and maybe increase the 20% to 30% if you want to allocate more profit. But the whole idea behind the framework is to help you solidify what you should be doing with your profit on a monthly basis. So we always suggest setting up money dates with yourself. It could also be something that you use that same time to do your bookkeeping, but then also you're able to allocate where your business profit goes. And then that way you have a steady system for keeping track of how you are saving for taxes. And that way you're not as unprepared when it comes to you making any quarterly estimated tax payments or coming tax time when it's time for you to pay if you do owe a balance. All right, so another thing is also being understanding the significance of making quarterly estimated tax payments to avoid penalties. So again, shifting from being a W-2 employee to being self-employed, you now are liable to make quarterly estimated tax payments. So what does that mean? From the eyes of the IRS says that if you are self-employed and you expect to owe $1,000 or more when you file your tax return, then you are liable to make quarterly estimated tax payments. The tax payment system throughout the government is considered a pay-as-you-go system, which is the reason why when you are receiving a W-2, you are paying as you go. Every time you get your paycheck, they take a little bit at a time. The IRS expects the same from us as freelancers, entrepreneurs. They want it to be paid on an ongoing basis, pay as you go. And they do that by way of estimated tax payments. So the rule of thumb, again, is if you expect to owe $8,000 or more when you file your tax return, then you are liable to be making quarterly estimated tax payments. And if you do not make them and you file a tax return where you do owe over $1,000 or more, the IRS will assess what is called a failure to make adequate estimated tax payments. Because again, the idea is around this pay-as-you-go system where they want you to be paying in your estimates quarterly. So that also goes and ties back into the power of knowing your numbers, why your bookkeeping is so important and why that's the foundation to everything. It also goes forward to the 50-30-20 framework of you allocating 30% for taxes and being able to allocate that and have that saved so that you can avoid any penalties. And then not only that, but to also be aware that you actually need to be paying these amounts in, especially if you are a freelancer that typically owes, paying them in quarterly will help you prevent any penalties. I have a lot of freelancers, entrepreneurs who save this money at the end of the year instead of actually paying it. But when you are doing that, you also still are susceptible to the penalty because you did not make the actual quarterly estimates. So this is why the significance of making quarterly estimated tax payments are so important. Not only does it help you avoid penalties, but it also just helps prevent that build up. Nobody wants like a huge tax bill when it comes to tax time. So it really just helps you to be proactive so that you are planning for it during the year. So setting the foundation with bookkeeping, setting up through the 50-30-20 framework, these are all practices that you can put in place to help you become just very more aware of your finances throughout the year. All right, and lastly, the benefits of consulting a tax professional for tax planning and for maximizing tax savings. So especially when you get into entrepreneurship, you may feel like you don't know what you don't know. And I always say that when you get to that area, it's always best to seek a tax professional If you were to ask me, when do you think it's time to outsource your accounting or when it's time to outsource any of your tax prep, it really just depends on your personality. You know, if you are used to preparing your own taxes, you may also be okay preparing your taxes as a freelancer, as long as you just have the knowledge that's necessary. So it all just depends on your personality, really, that determines when you should outsource. But I would say when it becomes too complex, especially if you are receiving income from all different types of sources, if you feel like it's uncharted territory for you, or if you feel like you just don't have the time, these would all be signs that you should consider outsourcing your either your tax service, either tax preparation services, or bookkeeping. But then also, you may want to have assistance with tax planning, and that's where you are strategically trying to figure out, how could you lower your tax liability. But keep in mind that as you're doing your bookkeeping and as you are looking at expenses, that the IRS says that anything that is ordinary and necessary for your business is considered a tax deduction. So when you are thinking of certain expenses and you're trying to figure out, like, is this a deduction or not? Just ask yourself those two questions. Is this a ordinary expense? Meaning, is this something that is ordinarily purchased in my industry? If I'm a photographer, with a camera, be something that's ordinarily purchased in my industry? Yes. The second question to ask yourself is it necessary? Meaning, was this purchase necessary for me to be able to do my job or to provide this service? And if the answer to both of those is yes, then that means that what you are thinking of deducting is a valid business expense. So hope this was helpful. Hope this gave you some really quick tips to think about as far as you setting up the finances to your business. Just as a recap, making sure that you set the proper foundation through your bookkeeping and the knowledge of knowing your numbers, making sure that you set some kind of budget. The 50-30-20 framework is a really good key budget to consider that allows you to pay yourself, but also save for taxes and leave some left over to reinvest in your business for profit. And then also, the power of, tax deductions and reaching out to a tax professional. So any questions anyone have that anyone want to bring to the floor? Is there a rhyme or reason, or do I just go to the chat, Michelle?
No, I'll ask you questions. You can just, all you have to do is answer. So lots of questions. I also feel like, thank you. I feel like I just have in general a lot of questions myself. So here we go. Do you pay into Social Security as a full-time freelancer? What happens to the money you paid into it when you were on a W-2? Do you still get Social Security when you retire?
Yes. You still pay in by way of self-employment tax. The 15.3% is the portion that's paid in for Social Security and for Medicare. As far as, you having that, when you retire, that's the goal. Some people feel like the system will, run out in the future, but the goal is that, yes, you're able to reap those benefits in the future.
Love that. Such a great question. Can you talk about the tax pros and cons of being a sole proprietor versus an LLC?
Yeah. So when you are first starting your business and you are automatically considered a sole proprietor. So a sole proprietor is an unincorporated business that one person owns. So there are no formal forms or anything that you have to do. You just, kind of wake up, you determine that you want to be self-employed. The IRS considers you a sole proprietor, which means that you will file on a Schedule C. So the difference between a sole proprietor and an LLC is that first, the sole proprietor is a tax status versus an LLC, that's more of a legal status. So if you are wanting legal limited liability protection for your business, you can go to your Secretary of State and you can apply to be an LLC, but you are still a sole proprietor for tax purposes. But you're an LLC as well for legal purposes. And that is what creates that umbrella of protection between you and your business assets, which is why it's so important to keep everything separate, right? Because if someone was to sue you or you'd be in some kind of litigation, it would be hard to substantiate things if you have everything commingled. So the whole idea of the limited liability protection really goes hand in hand with the power of also separating business from personal, so that if someone were to come after any business assets or anything like that, you have everything completely separated from your personal. So to answer your question in a synopsis, a sole proprietor can also be a LLC as well. Like they could be both. The LLC gives you the legal protection, but you would still be a sole proprietor filing on a Schedule C for tax purposes.
Yeah, let's go down this road a little bit farther. There's a couple questions here about Darylyn says, my small business is a single member LLC. What's the tax benefit of switching from an LLC C Corp or an LLC S Corp? And then same question for Matt to just talk about an S Corp.
All right. Okay, so these are really good questions. So think about it. When you are first starting your business, you are a sole proprietor. You wake up, you decide you're self-employed, you're automatically a sole proprietor to the IRS. You file on a Schedule C. Then you decide you want limited liability protection. You take it a step further, you set up an LLC with your state, but you are still a sole proprietor for tax purposes. This changes if you decide to transition to a different tax structure, which would be S corporation. It could be C corporation. The most common one and the most what I would call one of the most tax advantageous ones would of course be an S Corp. And an S Corp is where you also have limited liability protection, but what it does is it creates an entity of itself. So you are now filing on a different form, an 1120S, and your income flows through to your personal income tax return. So the big tax advantage of being an S Corp is that you no longer are subject to self-employment tax. So a lot of the questions behind, freelancers, entrepreneurs is, why are my taxes so high? And it's because not only are you paying regular income tax, but you're also paying self-employment tax, which is that 15.3%. When you become a S corporation, you bypass that 15.3%, which is what makes it such an attractive business structure to go to. But the caveat behind that is that you now have to pay yourself a reasonable salary by way of a W-2, which means you now need to be paying yourself on a W-2, and then you pay payroll taxes. So I have completely forgot what the question was.
That was amazing.
I really hope I hit that. And if I did, tell me in the comments that I hit it.
I feel like I have read so many blogs about the difference in the benefits, and no one has explained it like that. That was incredible.
So Nacondra, I have a quick follow-up. What is the IRS test for a reasonable salary in an S Corp situation?
Yes, that is a really good question. It depends. So the reasonable salary is going to be based on, for example, I used a photographer. So if a photographer decided that they wanted to be an S Corp, a reasonable salary is based upon, certain metrics, like what is a photographer, what's the average salary for them? It could also be locality based on where they are. A person that's in the South is much, different than somebody that's in New York, right? They may have a higher salary. So what the IRS states is that it needs to be reasonable. Reasonable is based on your industry. What is the industry standards of what a photographer is making, right? Also, locality, location. What are people in your area, what are they making as far as in that industry? So those are certain metrics that the IRS has as a way for determining what a reasonable salary is. And it can differ based on where you are.
Thanks.
So good. Nick asked, are receipts still important in bookkeeping, or are credit card statements okay for this current day and age?
Oh my gosh, such a good question. So the IRS has not yet stated or updated tax law in a way that says that they are no longer asking for receipts. What that means is that if you were to ever be audited or examined, the IRS could always ask for receipts. And so I won't tell you not to keep them, because, you know, if for some reason the IRS ever asks for substantiation, receipts could be one of the things that they ask for. So I still tell my clients that it's still a good practice for you to keep your receipts, whether that's in a Google Drive, or if there's like in a Dropbox, or even attaching it to QuickBooks if you have an accounting software. And that's just a good practice just in case. At a worst case scenario, if for some reason you were ever to be questioned.
Yeah, let's keep a follow-up to that. Can you talk more about audits? What are your chances of being audited as a freelancer? And what tips or insights would help a freelancer be prepared for an audit?
That's a good question as well. I have a ton of content about this with hot topics around what is a risky business to the IRS. So, you know, the IRS has a system that processes tax returns, and they look for certain key indicators. So of course, when your tax return is electronically transmitted, it goes through a system of checks and balances. And there are certain things that the IRS looks at that can kind of be a red flag on your tax return. One of them, of course, is having a lot of losses. So if you have a significant loss on your tax return, that could be like a red flag. An example of this would be like if you have way more expenses than income. Another red flag could be running consecutive losses. So like every year you have a loss, every year you have a loss. And the reason why that is because the IRS has what's called hobby rules, where if you are running a loss 3 out of 5 years, the IRS could always come back and say, you know, are you really running a business, or is this a hobby? You know, because you're running losses like every year. So that's also kind of something to be cognizant of, but also like anything that's truly excessive. So like if you have like a lot of meals, or like a lot of travel, like things where you have just very large expenses, especially in proportion to your income. These are all things that could be potentially like a red flag. And what I mean by that is it could, you know, cause the IRS to like want to investigate or question those things. So as far as the chances of being audited, there's not really like a percentage I could give you, but as far as like tips and insights, those red flags are things that you should be, you know, mindful of. Having a huge home office expense, just, you know, having a lot of expenses in proportion to your income, things like that are red flags that could potentially cause you to be questioned when you submit your return.
So good. A question about the 50-30-20 framework. Is it better to apply that to each individual payment you receive from a client, your monthly income or quarterly income? And the asker says, I imagine the answer is it depends, but curious to know if there are pros and cons on how to apply it.
Yeah, so I would say it depends. You know, is your income in large payments? Like, are you getting like larger retainer payments, or are they smaller payments? And how do you get paid? Is it infrequent or is it frequently? If you have maybe larger payments that are not as frequent, and you just get maybe larger retainers, then maybe doing it per payment could be ideal for you. I think it depends on your business model, how you're getting paid. It could be easier for you to do it on a monthly basis, but of course, that also may be an adjustment for you as far as how you're paying yourself as well, especially if you've been doing it a certain way. But you could do it on a monthly basis. I would say at the very least, do it monthly, not quarterly. And then also, depending on how you get paid, you could tweak it if you want to do it like, you know, per payment, or maybe on a bi-weekly basis, for example.
Love that. Nick asks, how do you recommend projecting your income for the year if you aren't getting consistent income?
Well, what I would first say to that is, I guess it would depend on how long you've been in business. So I would say that if you have been in business, a little while, and you have maybe a year or two of income, you may be able to kind of project the way your previous years have been in order to kind of get more context with how this year is going. But if not, as far as projecting your income, it would probably just be based upon whatever your efforts are this year. So as far as like any incoming leads that you may have that you're able to project, I guess it would depend on your business model, to be honest, as far as like how you would realistically project your income for the year.
Love
And
that.
that may not be helpful. I'm sorry if it's not. I think that's kind of like, it depends, right? Like
no, go ahead.
like there's not like a straightforward answer to that, unfortunately. It would kind of depend on some variables, right? To really, like, I'm being honest, like to really determine like if, like how you would project your income for the year.
Going back a little bit, you talked about reasonable salary for when you're an S Corp. What if you wear several hats in your freelance business, like you are a designer and you account manage and project manage? Did those come into account when you think about your reasonable salary?
So yes, a reasonable salaries would still compile, because you're still essentially you're a CEO, right? So even though you could be wearing many hats in your business, such as the designer, the account manager, the project manager, you're still a CEO of the business as well. So there's, to me, caveats to it, because it's not just based on the industry per se, it's also based on your income. So like, for example, someone who's running $1 million business with a higher profit, their reasonable compensation would be different than someone who is making $250K in their business with a different profit, right? So yes, reasonable salaries would still be applicable. I think it would just be based on your business skill, but it would also be based on your numbers as well. And then, through that, you would be able to really come up with some type of reasonable salary. You may have to get like maybe a tax advice around that, especially maybe someone looking at your numbers to kind of help you navigate what that would look like. But I do still believe there is some type of reasonable salary that you would still be able to give yourself based on your numbers, even if you can't navigate the industry per se.
So good. A question on retirement, which I will read directly because I am out of my depth just reading the question. What are the pros and cons of SEP versus a solo 401k? Or maybe for like, those of us who might be like me, just talking about also thinking about retirement as a freelancer as well. Like, what are good practices in your framework to think about retirement?
Well, the SEP IRA and the solo 401k are very different. And the reason why is because the SEP IRA, you are only contributing from, just either, 25, it's like either 20% as a sole proprietor, but like 25% if you're an S Corp of your W-2. But you are contributing based on either the profit from your business as a sole proprietor, Schedule C, or from a percentage of whatever your W-2 is. So like 25% of your W-2. Versus if you are a solo 401k, you contribute two ways. You contribute as an employee and you contribute as an employer. So that allows you to make a much higher contribution, because you're able to make elective deferrals. So especially if you're an S Corp, this is a powerful tax strategy. I have many clients that I've been able to really significantly reduce their taxes with just the transition to an S Corp plus a solo 401k. Because the solo 401k will allow you to make elective deferrals. So you're able to, make contributions that reduce your W-2, right? You're able to do it just like if you were working at a company. You're able to, make contributions into your 401k and it reduces your income. But then also you can make what's called employer deferrals, where you're able to also do a profit sharing contribution. And that allows you to be able to contribute significantly more. So it's a very more attractive, I'd say, retirement strategy, especially if you are wanting to really reduce your income tax liability, and especially if you are the sole employee. For solo 401ks, if you end up hiring multiple other employees, you won't be able to use that strategy, but it's a great strategy for one employee S corporations who really want to leverage that as a tax strategy.
Whew, so amazing. We just have a couple of minutes left. And so I would love to give you, actually, Jeff, did you want to say something? Sorry. I felt like you looked like you were going to, okay. I wanted to give you a couple of minutes because we did have a question if you are taking on new clients. So I love to know kind of if you would talk about exceptional tax services, kind of what you do, and if you're taking on new clients.
Yeah. Mm-hmm. You can go to our website. We have a ton of resources, you all. We have a blog post that we update very regularly that has all types of information. I have a podcast where I talk all types of things there. But yes, we're taking on more clients. The heart of our business, of course, is accounting. So we do tax prep, we do S corporation elections. So we don't advise anyone to blindly go into a S Corp. So we run the numbers, make sure it makes sense, make sure you also understand the compliances before you make the decision, meaning what is it going to cost you? And does that outweigh does that still give you tax savings if you do elect to become an S Corp? So while it's a very attractive tax strategy, we really help educate around what that looks like, and even the mindset piece from shifting from being a sole proprietor to being the owner of a S Corp. We also, of course, do bookkeeping, and we have advising, and we also have the House of CEO, which is our membership. We do monthly workshops. The workshop we have coming up is on the 50-30-20 framework. So we have these workshops on a monthly basis. So yes, you can go to our website, our social media. We have a ton of resources just all around education for business owners.
I'm gonna put your link here in the chat as well, just so folks can find you. Sorry, now I'm typing and just that guy on the Zoom call is typing.
Mm-hmm. These are such good questions. Oh my gosh.
Well, thank you so much. Sorry, go ahead, Jeff.
Yeah, I was going to say, we're going to have to bring you back right before the April deadline next year, or just later.
I can come back for tax season and share with you all the steps to get ready for taxes, like a tax prep 101. I'd love to share that with you all to make you all just more organized. So of course, I'd be happy to come back.
I love this. Kara
Awesome.
just echoes what's in my brain. She says the topic is so intimidating, even for folks who are scrappy and comfortable doing a lot of research to get things right. I feel like anytime someone talks about taxes, I just try to avoid it. So thank you so much for being such an amazing resource. Encourage you to check out Nacondra's website and her resources. And we will see you back here in 2 weeks. We're talking about personal branding next time around. And make sure if you're not in our community, we'd love to make sure that you're part of our Facebook community as well. And then you can make sure that you know when we have Nacondra back to talk more taxes.
Awesome. Thanks, Nacondra.
Thank you. Bye, everyone. Thank you so much. I appreciate it.
See you in a couple weeks.